This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
As both tax strategists and real estate investors, Matt and Amanda combine their passion of real estate investing with their expertise in tax strategies. Their goal is to help investors with strategies designed to supercharge their wealth building using entity structuring, self-directed investing, and income offset opportunities to keep more of what they make. I think what's interesting about all these contemplations is sometimes rules are dreamed up by people that have no idea of the domino effect that it creates. Mm-hmm. And so you can imagine saying, okay, we're gonna tax your stock gains. Okay, well, you're going to crash the stock market by 50%, probably, in a very short period of time, and you don't have revenue, but you've totally wrecked the finances of a lot of people. 1031 exchange, you're not going to allow that. Well, you just ended the broker's career that has apartment listings, because it's just not going to happen.
Yeah, and I was on a webinar where a 1031 exchange expert was talking about how people who, buy real estate are the ones that make significant improvements, as a new owner. And so it's really good for the tenants versus the people who, hold the properties for many, many years are less likely to make major improvements. So that's, just kind of from a tenant or market perspective, that's another benefit of the 1031 exchange, allows real estate to move hands.
Let's talk about 1031 exchanges. I'm going to just kind of play with the transaction and then have a couple of questions, because we do have a situation where some of this has come up. So let's say we have a $2 million property. It's in escrow with $1 million of debt on the property. My time frame for putting something together and actually closing it, there's two pieces of it. One of them is, go ahead.
Yeah, no. So there's basically two time frames of the exchange. There's the 45-day identification period where you've got to identify the one or more properties that you're going to eventually purchase as your replacement property, and then in addition to that, they give you 180 days from the date of sale to close on the replacement property or properties. That's the general time frames.
Right, and that 45 days, and you did say that is included in the 180. It's not.
Yeah, so they're both measured from the date of sale. They're not, the 180 is not tacked on to the 45.
If I owe $1 million on the property I sold, what's the ramifications for not having $1 million of debt on the property I buy?
Well, it's actually the way they look at that. There's two monetary requirements that you have when you're doing an exchange. One is that we call it the purchase price replacement target. So in your example, if you're selling for $2 million, your purchase price of the replacement property's got to be $2 million or more.
Okay.
And the other one is the equity replacement target. So in your example, you've got a $2 million sale, $1 million of debt, you've got $1 million of net equity. You've got to put that $1 million of net equity into your replacement property. So the actual amount of debt on the replacement property doesn't really matter. You could actually have zero debt on the replacement property. It's just that you could put your $1 million of equity into that one and then bring other cash to the table, or you could bring some cash and get a lower amount of debt. So the debt actually doesn't matter. It's more the equity that you got to roll in.
Okay. So let's say you've exchanged an apartment building with these numbers approximately, and you've 1031 you've nominated new homes that are being built, and then the coronavirus thing happens, and you have things that were out of your control. So you have supply shortages, which is true. And you have even like health inspectors that are on the job site when they inspect things like septic tanks or, sewer systems and all that. They literally have been taken off the job and been told to go give shots. So you have a big hole in the time gap. So I guess my question is, what's the IRS's stance on something that's completely out of your control in like an emergency situation? Like if you were shut down in California, for instance,
right.
you would have no way you could finish something. So I guess,
is there any new talks of extensions? like they had, in the past.
Yeah, I know, so this is going back, I guess, to last summer. There was people that were having that 180-day deadline that was going to fall between, I think it was April 1st and July 15th. It was extended to July 15th. Now, obviously, we're past that. I get that. But so that was one thing that they did do with the CARES Act to kind of extend the 180-day deadline, for lack of a better term, along with a lot of other things, obviously. But yeah, I think in those situations where things are out of control, I think there is some, I don't know exactly off the top of my head, there's probably some private letter rulings you might be able to file, but I think there's other things that I feel like there is some, you have some leeway, I guess, for like, that would be a good question, I think, for like an exchange intermediary.
Yeah. Okay.
Because yeah, those construction exchanges are, yeah, they're obviously their own lone little beast, right? Because then then you're looking at, okay, when do you spend all your money and how do they measure that, right? And that's kind of getting to your question is, well, I can't even spend my money because even if I got the materials, no one's here to install them, right? Like, sitting in the
Okay.
dirt.
Yeah.
What is the tax ramification for that? So when the IRS says, okay, well, you got 75% of the way there, you basically, spent 750 grand of your net.
Yeah. I mean, in a typical scenario, if someone's doing a construction exchange and they just don't get to spend all their money by the deadlines, the way it's taxed is it's really on the shortfall. So it's not pro rata based on, is it 75% complete and you got to pay tax on 25%. It's really, if you were supposed to spend $2 million, you only spend 1.8 million within the deadline, then you're going to pay tax on that difference of 200 grand in that example. So you have to know what your gain is, obviously, on selling the first property, right? So your sale
Right.
price, your basis, but then you'd figure out the shortfall in terms of dollars. That's in a normal situation, obviously, excluding COVID, but.
Okay. So many topics. Okay. Estate taxes. I'll just cover this very briefly. Currently, how large of an estate can you pass on to your family without it being taxable? And does that change in 2025?
Yeah, right now the estate tax exemption for an individual is about just under 11.6 million. So you double that for a married couple, 23.1, 23.2 million. So essentially a married couple could, if they happen to both pass at the same time, they could have an estate worth under $23 million, not have to pay any estate tax. Based on the current law, I think at the end of 2025, it's going to revert back. Those exemption levels are going to revert back to 5 million, if I remember correctly. Essentially meaning, there's some things to do between now and then if people find themselves in that ground
Right.
of between 5 and 22 or whatever,
If you pass the maximum allowed for any particular year or law, what is the estate tax, and is there a federal and a state estate tax?
So right now, the highest federal estate tax is at 40%, and I don't know about other states. State of California actually doesn't have an estate tax. Now they
What?
do tax. They do charge an income tax on an estate. So somebody passes away, it takes a year and a half to kind of dissolve everything. The income tax paying entity at that point could be the estate, and the estate would have to pay some income taxes depending on what it earns and things. But yeah, that's where things are currently standing.
Okay. We're kind of running out of time. We got another 5 or 10 minutes. So I want to cover moving out of California, because you're saying you have a fair amount of people that are asking you about it. So I've heard the state of California is pretty vigilant on making sure you actually left. So especially if you're saying you live there half of the year plus a day. So
now, again, we're just talking hypothetically here, right? We're not talking about anybody we know.
I already live in Florida. I'm talking to you from Florida. Yeah, that's why at the end I say my first year as Florida resident, words of advice. But I'm actually here full time. But I think a lot of investors, I know some of them, they're going to live half the time in California and half the time in another state that has no tax, and they're going to probably be challenged on that.
Yeah.
If they don't do certain things.
Yeah.
So what is your experience on that? Well, what do they need to prove and keep track of for them to be okay?
I mean, California is, extremely aggressive in residency audits because, we joke, and in the eyes of the FTB, no one ever leaves California in reality. You're here forever. And so really we're talking, we're talking about actually leaving. I know the people who say, oh, I'm going to just buy a little condo in Nevada, but I'm really going to be here. No one's going to know. I think you can have a really hard time arguing. FTB has said they're using technology to also track the whereabouts of people. So it's more than just saying I'm not here, but they look at social media, they look at LinkedIn, going to that extent to really figure out where are you or where do you say, are you where you say you are? But, the obvious things that they do obviously is voter registration, DMV registration, where you licensed professionally, right? So if you're saying you live in Florida, do you now have a Florida realtor's license, right? If realtor is your business,
Right.
Your doctors, where your primary physician should not be in California, where you're getting your prescription medication. So those are just some of the basic things. But yeah, they're looking at bank statements. They're trying to figure out where you're spending your money. If you're saying you're in Nevada or Florida, but there's a lot of charges from your account from Home Depot in California, then you might have an issue in terms of why that's occurring. So they have a kind of a long laundry list of things that they look at. So it's really, to really not be in California for tax purposes, you really need to physically not be in California for the most part.
Okay, that makes perfect sense.
Bruce, we got a little more time than you think.
Okay. When somebody thinks they're being unfairly coerced into you're still a California resident and they believe they are not, what are their options? Is that like hire an attorney time and challenge the tax system?
Yeah, because I think if you get to that point, you've been audited. The stuff we're hearing is that the funny thing, and it's not funny obviously, but it's once you are selected for audit, kind of as Amanda was saying, that they're looking into Facebook and all these other things. They've already built the case at that point. They've already got all the background information, probably maybe even more than you even know about yourself sometimes, So if it gets to that point, yeah, it's time to kind of hire the tax attorney that can deal with appeals and, fighting the state for you because.
Yeah, but I think the good news, at least in our experience, we've never had to deal with a residency audit. So I think for most of our clients, either they're in California or they've really moved out. They still have maybe investment properties in California, but they're similar to your scenario, right? Where you are actually in Florida. You might come back here to speak or something like that, but there's not really, connection where you actually have your.
Maybe.
Uh-oh.
No, I am going to be back there in about 2 or 3 weeks, actually.
Yeah.
I'm going to wear a makeup and a beard though. So.
Well, you need to get one of those disposable phones, the ones that criminals use. One-time use
They're
phones.
not
The burner phones?
They're called burner phones. Come on,
Yes.
use the right term.
Oh my gosh. I didn't know that. Thank goodness we have Joey here for that one.
But I think the issue with it all, right, is that, if somebody moves out of state and they still have California real estate, that's clearly California source income, right? It's the stuff that the state is trying to go after is the in-between transactions of, somebody's, I don't know, somebody, like I was saying, or they've exercised stock options and they have a huge bump in compensation income. And they're trying to make the argument that, well, I was a resident of, Nevada during that period of time. So maybe that compensation income, that bump is not taxable in California.
Right.
That's a gray area, right? That's one of those things that California is going to want to go after. It's not as clear cut as the property's clearly not in California or something like that,
Right.
And we, because of COVID, this is something that we've seen a lot where we have clients that are spending part of the year outside of California. So one thing they look at is your time outside of California, is that permanent or is that kind of short term?
Right.
Meaning, okay, well, I work for Google. Google said I don't have to be here until the next 6 months. So I moved to Florida for 6 months, but my home is still here. I'm coming back, wink, wink. So California's position is still, no, you plan to come back. Your employment is still here. You're only there for, a long Airbnb stay, if you will. That's not really going to work. It's really just, I am moving to Florida. Again, it's okay to be back here. Like if you're here working or, you're doing teaching and things, that's perfectly fine. It's just, you really need to establish your home as not, no longer in California.
Okay. When I sell a property in California, I know when I file taxes, I have a form, right? I have to fill out on the rental property that's chasing this property till the end of time, right? Basically, you made your money in California, but you exchange it, but we're not letting you go.
Yeah.
The day you sell that property, make a profit, we want our cut. Has that been challenged legally, or is that just an accepted, that's okay?
It probably has. I'm not aware of anything recently that people are trying to go into that, but that doesn't necessarily mean anything. It's,
I've not heard that it's been overturned, I guess,
Yeah.
is the best way. So we're still filing those forms.
Yeah.
Until there's guidance that
I think,
says you don't have to do
I
it
think the
anymore.
thing is the rule has actually been in place for a long time. It's just they came out with that form a couple years ago to kind of put it on paper to really start making people track it on paper, because I think the state realized there was some loopholes they were missing out on, I guess, if you will.
Okay. I'm going to go to the last few questions that I have, and then I'll back into the IRA and Roth questions. But this is a question about what do you think your clients will do if something is passed, the categories. So what do you think your clients will do if they passed changing the 1031 exchanges? So let's say that tomorrow they say, yep, 1031 exchanges are coming to an end nationally. But it'll last the year.
Mhm.
Knowing what you know about your clients, what do you think they would do? Would they sell and complete an exchange? Would they just say, hey, I'm just gonna hang on to it?
Yeah, I think if if it's an immediate in effect date, meaning tomorrow
No,
no longer
it starts January 1st.
of
So
next year.
yeah, they got a whole
Okay.
year. What would
Yeah.
they do?
I think people would reevaluate their portfolio and really try to figure out which ones to sell and which ones to keep. And the ones to sell, a lot of people would try to sell before the end of the year. I mean, 1031 exchange is not the only strategy to defer taxes. There's other offset strategies like depreciation and things like that from your other properties that you can
Right.
always use. But yes, I think if it becomes in effect next year, we'll see a lot more 1031 exchange than we normally do. And we've seen a lot of 1031 exchange in the past 2-3 years, just because of the appreciation in the market and, just changes to California law, right? In terms of tenant and landlord.
Sure.
So we've seen a lot, and I think it would just be, exponentially more if that were to happen.
Okay. What about taxing unrealized stock gains? What do you think the stockholder that you have would do?
If it's going to happen next year, then
Yeah,
probably
you got a
lot of
year.
people- yeah, probably a lot of people will be reallocating the stock too before the end of the year.
Well, when you
Or
say
you-
you're reallocating or just getting out
I
of
mean,
stocks?
getting out, yeah. But I don't know if our clients would be a good example of America as a whole, just because
Okay.
our clients are so heavy in real estate. So our clients are always looking to move stock to real estate anyways. So if we think that next year there's, going to be more taxation, whether it's unrealized stock or higher capital gains, you might see more people exiting stock and moving it to real estate.
Okay. All right. Let's say they raise the capital gains to 39%. What do you think your client would do?
Well, if it passes under the current law where it's going to go into effect if somebody has over $1 million in income, I think there'll be a lot more emphasis, as there should be, put on tax proactive planning, right, to bring your income below $1 million, so you can keep, if you do have the capital gains or whatever, you're keeping your taxable income under $1 million so that it doesn't apply. But obviously, if they can't, if we're talking $10 million or something, yeah, I think it's going to be there'll be a lot of more consideration in terms of the timing of things, like how often are you going to sell? Am I going to sell one property this year versus 2 or 3, that kind of thing. That's something.
Or maybe even exiting the asset class. This is the point of that line of questioning, is a lot of this is designed to raise tax revenue, and sometimes it does just the opposite. This won't be the only time that the capital gains tax rate is as high as the federal tax rate.
Yeah, because I think, I mean, the people who make 400,000 or more, the people who are $1 million or more are usually people that don't have to make these moves, right? It's like, I have to sell the stock in order to pay mortgage or pay rent. So yeah, it's I think you're right in that some of these, even though the tax increases, these are the kind of people that have the ability to decide when to do these things, or just, not to make any movement at all in general, which then would just lead to, not really any significant increase of tax revenue.
Yeah, my guess would be that you'd have negative tax growth to the surprise, perhaps, of the people that thought it was going to raise a lot of revenue. That long list of taxes that are possible for somebody making over $5 million in California. I mean, if you actually have a tax rate that approaches 65% combined with state and federal, to me, that's a number that probably somebody would contemplate not being here.
Oh, for sure. Yeah. I mean, if you get to the situations like that, that's going to be push probably a lot of people to exit sooner than, maybe they were planning 5 years down the road when somebody is done in high school or, whatever, but maybe that accelerates the plan,
Yeah, unfortunately. Well, that's what's been, it's interesting. I'm not a big fan of politics, and the narrative that's being sold, of course, is that the people that have assets and wealth aren't doing their part. And yet when you talk about like one tax filer, or this group of tax filers, just they live under a roof like other people, are paying 40% of the bill for the country and the state. That's, we ought to be happy that guy showed up, right? and did what they did, but it's sort of the opposite. So that's the problem with all the policies. They have only a group to chase that is paying most of the taxes now.
Yeah. And it's interesting, earlier you were saying, do we know how are these tax changes actually made? Is it voted by, people in Congress or at the state assembly level, or is it by the voters? And because, you said we don't remember actually voting to increase our taxes back, even up to 12%. But even if you do have the people vote, right, I would think a lot of people would vote for these tax increases. Because
it's not theirs.
It's not mine.
Yeah.
That's the unfortunate part, is not seeing kind of the bigger picture of how that impacts California as a whole, or maybe the US as a whole. But yeah, some tough decisions, I think.
One of the things, I do get asked by this question by a few people. Do you think our retirement account money are safe? Which is that's a scary question. In other words, you're doubting the integrity of the whole system when you ask that.
Yeah.
In other words, that money that I prepaid on my taxes and have a Roth, the thought is they're going to come and take that. You're just going, wow, I wouldn't want to land on that square every morning. I just can't.
Well, what I think when, we first met, you started working together, it was back in 2010. That was the year of the Roth conversion, right? Where, you can, convert all your money to Roth. And a lot of people were asking those questions back then. Is it likely, what if they want to tax it again in the future? I know back then, at least my response was, well, anything could happen. US could become a communist country, but it's not very likely. That was, I think, how confident I felt at the time. But obviously, things have changed. I don't know that they're gonna necessarily have a direct, let's tax Roth money, but it might be some kind of brand new tax or fee.
Or maybe,
Roth.
or maybe because that law change back in 2010 was to allow anyone going forward, regardless of their income level, to convert to a Roth if they wanted to. So maybe they start putting a cap on that back again, where, if you make more than X dollar amount, you can't convert your money to a tax-free bucket because we want your taxes at some point,
What is the conversion rate? Is it just match your tax rate, or is it?
Yeah, it's just taxed at whatever your ordinary bracket is at that point in time, for that year. So it could
okay. Well, is it taxed without considering how much money you're transferring, or is that money on top of whatever you made? So it puts you in a different bracket, most likely.
It's no, it's included in everything. So it's if you're in the 35% bracket and you've got enough Roth conversion to push you into 37, some of it's taxed at 35, some of it's taxed at 37, but it doesn't change how everything else was.
Okay, well, I was just thinking of the rare person that's, let's say, at a 10% level this year, because it's been a lousy year,
Yeah.
but they
So-
could transfer their $1 million IRA to a Roth. They'd be taxed at 39 or whatever, 37.
Well, most of it, yeah, but some of it would be taxed at 10%, 12%. But that was definitely something we talked to clients about last year was, hey, I know 2020 has not been a great year for a lot of people. So that might be the year to look at doing Roth conversions, because take advantage of some of those lower brackets if you find yourself down there,
Too bad it's not a capital gains tax rate. I did all that in 2010, so that was a good thing. But I asked that question a little bit with personal interest because, yeah, you kind of go, oh, they're not going to change that one, are they?
Yeah, see, yeah. So back then it was like unthinkable, no one would ever even really ask that question, but.
Yeah, and you know what?
No.
You don't even like thinking like you have to think like that.
Right.
I don't like that, and I'm not buying that. That's what America is going to become.
Matt and Amanda, there's throughout this conversation we've talked about what's actually going to be implemented, what won't, what will change. If I'm just a real estate investor or somebody just paying attention, is there a time frame that you guys look for, or when? Like, is it going to be July? Is it going to be September? Do you guys have any idea, or is it just like to be on the lookout for everything?
Yeah, well, no, I certainly don't have any insider knowledge into when these will happen, but there are talks that, as early as February, end of February, that, more definitive proposals could come out. And then, there's going to be, Congress will vote on it and back and forth. So who knows? But, I think on our end, it's one of the keys for us is the timing of the change, right? So yes, one thing to know what the changes are, but when will it take into effect? Because it's, best case scenario is it takes into effect in phases, maybe starting in 2022 and then phasing in over the next couple years. So we have plenty of time to plan. But yeah, for anything that's retroactive to January, that would be a lot more difficult to plan, because the year is already happening. And especially, with respect to more transactional tax changes, like allowing or not allowing 1031 exchange, right?
Yeah, I don't.
If that's retroactive, we're done.
Yeah.
Hold on to your properties for a while.
So who do you guys pay attention to see what's coming around the bend?
Bruce Norris. No, like we said, we try and attend various industry like CPA trainings throughout the year, just because. So the last couple of years have been so many changes, but yeah, I don't know. If I was a betting man, if they're going to change like the rates and the things like that, I think that's something they would probably wait till like later in the year, change it, and then make it retroactive at the beginning of the year. But the transactional stuff, like Amanda said, I think that would be really hard to say in August that it no longer applies for 2021, So,
yeah, that doesn't make sense.
I think there's more things on the plate that they're worried about. Hopefully they're, increasing the rollout of the vaccine and all that stuff. I think that's all that's on the forefront of their minds right now.
It's really interesting because, like the start of COVID, I think all my friends, are binge watching, various shows on Netflix. Matt and I were binge watching webinars from AICPA, California State CPAs, other CPAs, like colleagues of ours. And I think it'll be another year very similar.
That was like we talked about this before, Bruce, but that was like last year when the CARES Act came out. That was the epitome of what you mentioned earlier, where they pass something and then kind of figure it out later, because they passed the CARES Act. And then like 2 weeks later, they got some frequently asked questions and answers. 2 weeks later, they deleted those and brought new ones to the table. And it was the most amount of tax changes in the shortest period of time I've seen in 20 years of practicing, so it was, but and obviously it was warranted. It was, things were going on, and I don't, maybe hopefully it slows down the changes, but I don't see changes going away.
No. Well, guys, thank you so much for joining us. I knew it would be a fun hour, and it was.
How can people reach you? Are you guys even taking clients? Is that something that you guys want to plug?
So our website is www.keystoncpa.com. It's KEYSTONECPA.com. And we got a lot of great information on our website. And obviously check out our book if you haven't done so on Amazon. It's called Tax Strategies for the Savvy Real Estate Investor. And yeah, we're always happy to talk to clients about proactive planning. Although we are already at capacity for 2020 filing. So anyone looking to get their 2020 return filed, we already have enough clients for that.
All right. All right. You guys have a wonderful week and a great year.
All
Thanks so much, Bruce. Appreciate it.
Bye.
Okay.
Thanks, guys.
Bye-bye.
Thanks, everybody.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.